Picture this. You have been right all year. Not a little right. You have been violently right. Your account is growing so fast that your sense of risk starts to feel like an insult. Then one morning the tape turns on you. Prices gap past your stops. Liquidity vanishes, which means there are not enough real buyers and sellers at fair prices to let you exit cleanly. In a few sessions, your profits are gone. Then your capital is wounded. Then your confidence is shattered. The market did not change its mind about you. The market never knew you existed. That scenario is the shadow that follows the legend of Jesse Livermore. Livermore is often sold as a hero of speculation. He made and lost multiple fortunes. He lived through the panic of 1907, the roaring 1920s, and the crash of 1929. He is tied to the idea of the great operator, the trader who reads the market like a living thing. I respect his skill, but I study his mistakes more than his wins. Because his mistakes are the ones that keep repeating in modern accounts, in crypto, in meme stocks, in options, in leveraged futures, and in quiet portfolios that think they are conservative. The first lesson is that being right is not the same as being safe. People confuse accuracy with survival. In risk terms, I separate expected value from path. Expected value means the average outcome if you could repeat the same bet many times. Path means the order of wins and losses you actually experience. You can have a positive expected value strategy and still go broke if the path includes a drawdown you cannot survive. Drawdown is the drop from your peak account value to a later low. Livermore could be right on direction and still be wrong on sizing, timing, and staying power. Livermore understood market psychology. He also fell into the oldest psychological trap in speculation, the belief that your last win proves your next bet should be bigger. That is recency bias, which means your brain overweights what just happened and underweights the base rate, the long-run frequency of outcomes. After a streak, risk starts to feel lower. It is not lower. It is often higher because volatility rises near turning points. Volatility is how much prices swing around, and it tends to cluster. Calm periods breed leverage. Then leverage amplifies the next storm. When I look at Livermore, I see a man who could read trend, but struggled with the temptation to press too hard. Pressing is not always wrong. Paul Tudor Jones pressed in 1987, but he did it with a risk framework and a willingness to cut. The difference is not curve. The difference is controls. Controls are rules that protect you from yourself when your emotions are loud. Livermore sometimes had rules, then broke them when the market offered him the drug of being right. This connects to leverage. Leverage means borrowing or using derivatives so a small move in price creates a big move in your equity. Leverage is not evil. Leverage is a tool. The problem is that leverage makes time your enemy. If you are leveraged, you can be right eventually and still forced out today. That is margin risk. Margin risk means your broker demands more collateral when the position moves against you. If you cannot post it, you sell at the worst time. That is how many brilliant traders get converted into forced sellers. Livermore also shows the danger of confusing conviction with edge. Edge is a repeatable advantage, a reason you should win over many trades after costs. Conviction is a feeling. Conviction can come from research, but it can also come from ego. When you size based on conviction alone, you are letting your mood determine your risk of ruin. Risk of ruin means the probability you hit a loss so large you cannot continue. Survival is the first job. Without survival, there is no compounding, no learning, no second chance. One of the most practical mistakes to learn from is concentration without a plan for correlation. Correlation is how much two positions move together. In a crisis, correlations often go to 1, which means everything risky falls together. Livermore often took big concentrated views. Sometimes that is how you make a fortune. But concentration needs humility about regime shift. A regime shift is when the market environment changes, like going from low inflation to high inflation, or from easy credit to tight credit. Your strategy can work beautifully in one regime and fail in another. Ray Dalio built a career around studying regimes, because the same trade can be genius in one decade and poison in the next. A modern parallel is long-term capital management. LTCM had Nobel-level models. Their trades often had positive expected value on paper. But they were highly leveraged, and they assumed correlations and liquidity would behave like the past. In 1998, Russia defaulted, spreads blew out, and liquidity disappeared. Their positions became crowded. Crowded means too many smart players own the same trade. When crowded trades unwind, the exit is too small for the crowd. That is a hidden tail risk. Tail risk means rare outcomes that are far worse than normal. Livermore did not have a VR model, value at risk, which is a statistical estimate of typical worst-case loss. But he lived the same story. The market can make your worst case bigger than you planned. Another hard lesson is the difference between trading the market and trading your own life. Livermore had personal stress, relationships, and a public identity wrapped around his market persona. That matters because decision-making under uncertainty requires emotional bandwidth. When your identity is fused with your P&L, profit and loss, every tick becomes a referendum on your worth. That is a recipe for revenge trading. Revenge trading means taking impulsive risk after a loss to get back to even. It feels like control. It is usually loss acceleration. I also take from Livermore the lesson that rules are only real when they are enforced. Many traders say they have stops. A stop is a pre-planned exit that limits loss, but the stop only works if it is placed where it makes sense and honored when hit. In fast markets, stops can slip. Slippage means you get filled at a worse price than expected. That is not a flaw in your broker. It is market structure. Market structure is how orders actually meet, how liquidity is provided, and how gaps happen. If you trade instruments that can gap, like single stocks on news or thin futures overnight, your stop is not a guarantee. It is an intention. This is where position sizing becomes the adult part of the room. Position sizing means deciding how big a bet to take relative to your capital. The Kelly criterion is one way to size. It is a formula that maximizes long-run growth based on edge and odds. In real life, your edge is uncertain, so full Kelly is often too aggressive. Many pros use a fraction. The point is not the math. The point is that sizing should be driven by your worst case, not your best case. Livermore could make huge money when he was in sync with the tape, but the same sizing could destroy him when conditions changed. I think about Barings and Nick Leeson here, not because Livermore was a rogue trader, but because the failure mode rhymes. Leeson hid losses and doubled down. The institution lacked controls and incentives were misaligned. Incentives matter because people respond to what gets rewarded. If you reward short-term gains and ignore tail risk, you manufacture blow-ups. Many retail traders run the same incentive system inside their own head. They reward excitement, big wins, and social proof. They punish patience. They ignore the quiet virtue of small losses. That is a control problem, not an intelligence problem. Livermore also teaches me about reflexivity. Reflexivity means prices can influence fundamentals and behavior, which then feeds back into prices. In bubbles, rising prices attract buyers, which pushes prices higher, which attracts more buyers. George Soros talked about this dynamic. Livermore lived it. The danger is that reflexivity works both ways. When the trend breaks, selling triggers more selling. If you are leveraged, the feedback loop is brutal. You do not need to predict the top. You need to respect the fragility of crowded leverage. Now, I want to connect this to the investor side because not everyone listening is a trader. Warren Buffett and Charlie Munger built wealth by avoiding the need to be heroic. They focused on high-quality businesses, strong balance sheets, and long-time horizons. That is also risk management. It is just a different expression. They reduced the number of ways to die. They avoided leverage at the wrong times. They kept liquidity so they could act in crises. Liquidity is the ability to meet obligations and take opportunities without forced selling. Livermore sometimes had the opposite problem. He could be forced to act when he least wanted to. The practical question is what to do with this. I do not romanticize Livermore. I use him as a mirror. If you are trading, you need an honest map of your failure points. Not your strategy rules, your failure points. Are you vulnerable to overtrading when bored? Are you vulnerable to doubling after a loss? Are you vulnerable to holding losers because you need to be right? Are you vulnerable to concentration because one idea feels clean? Those are behavioral risks. Behavioral finance is the study of how human biases distort financial decisions. It is not academic trivia. It is your P&L. I also want you to think in distributions, not single outcomes. A distribution is the range of possible results and how likely each is. Livermore could nail a move, then give it back because he did not anchor his life to a stable distribution of outcomes. Professionals try to avoid dependence on one outcome. They diversify. Diversification means spreading risk across positions that do not all fail together. Diversification is not owning many things. It is owning things that behave differently when stress hits. It is also diversifying across time by not needing to swing for the fences every month. There is a final lesson in humility. Markets are adaptive. The more obvious an edge becomes, the more it gets competed away. The more money that chases a pattern, the less reliable it becomes. That is why I treat every strategy as perishable. I assume my model is wrong in ways I cannot see, so I size so that being wrong is survivable.